Your balance sheet is really powerful. It's a representation of your assets less your liabilities, and this equals your capital, which you may have heard referred to as equity. And these are reported at a given point in time. It's a summary of every item your business owns, less every item that your business owes. And essentially your equity is what you have left over. This is the value of your business. So naturally, we would like to see that you own more than you owe. But it can also tell you more than that as well. Let's look at a more detailed balance sheet. We have multiple account codes here, but what exactly do each of these mean? Your current assets will be your short-term assets. Assets which you'll have in use for less than one financial year, whereas your non-current assets, or your fixed assets, will be in use for more than one financial year. This is the difference between current and non-current. And exactly the same principle applies to your assets. Current assets will be short-term. You'll be repaying these in less than one financial year. Whereas your non-current assets will be longer term and you'll be repaying these over more than one financial year. Your net assets is simply a sum of your total assets less your total liabilities. And this comes in useful because the sum of this will also equal your equity, which is the value of your business, which also shows the funds your business has available. I would like to introduce you to Tom. He has been in business for a while now, and he trades in sportswear. So any items which he buys, such as tennis balls, footballs, and golf clubs, which he intends to resell onto the customer, will be his short-term assets, his current assets, because he intends to sell them in less than a financial year, before he passes over responsibility to his customer. Oi, pun. He also has office equipment and computer equipment. These may be referred to as his non-current assets, because he expects to be using these for more than one financial year. And don't be surprised if you've heard of these referred to as a fixed asset. This is actually a much more commonly used term, and this will be the term we use going forwards. He may also owe money, and he may have some short-term current liabilities, such as a bill, which will be repayable in less than one financial year. This will show in his trade payables, and we know this is current because if we check the invoice date in comparison to the due date, it is clearly repayable in less than 1 year, in this case 30 days. As well as owing money in the short term, he may have some longer term liabilities, such as a loan which is repaying over more than 1 year. This is non-current because it's a long-term funding source, and in several years' time he may still have a balance repayable. Now the total assets, less your total liabilities, will equal your equity. So you will see on your balance sheet that you have some subtotals which are totaling all of your assets, and another one which is totaling all of your liabilities. Your equity will also pull through any figures from your profit and loss report, such as your current year earnings, and also any retained earnings or losses from previous financial years. Remembering our balance sheet, it will be all of our assets less all of our liabilities, and this will give us our equity or our capital. So you will also find a subtotal for your net assets, which is simply a sum of your total assets less your total liabilities. This will be equal to your equity, and this is why it's called a balance sheet.